Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 1. This is section B5. This is a remembering and understanding topic. Calculate the effect of inflation on a product's real price or an entity's investments, debt, and future expenses. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full 10-question versions of these 5-question YouTube videos. At least that's typically the case. So again, in today's video, we're only going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of the video when we post it in the member forums so that they can get a little bit more help and a little bit more practice. So if you like this and you like our other videos, make sure you check out becoming a Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out as a really good strategy is reading the last sentence of a question first, because very frequently that will give you context for what you're dealing with in the question, and this is very helpful on exam day when you have no idea what you're about to see in the questions. Again, read that last sentence first to get that quick context. It will help you move more quickly. So let's do that here. What is the real cost of the contract at year end adjusted to beginning of year dollars? Okay, let's go to the top. At the beginning of the year, a maintenance contract for industrial equipment cost $1,500. By the end of the year, the price rose to $1,620. During the same year, the inflation rate was 5%. So again, what is the real cost of the contract at year end? So if you have any idea how inflation works, or if you've ever done this before, and if you know how to do the real cost, then that's great. Pause the video, do this on your own. But if you don't know, which is totally okay, we are going to use these questions to learn how to do the inflation questions or inflation calculations that you might typically need to do for the CPA exam. So let's dive into the explanation for this one to start learning. All right, here we are at the answer, C, 1,543. That is the real cost. So let's go through this explanation to learn what that means. To find the real cost in constant dollars, divide the nominal, so the actual cost, by 1 plus the inflation rate. So again, to figure out the real cost, we take the nominal cost divided by 1 plus the inflation rate. So that's $1,620. That was the cost at the end of the year. So that's how much the actual cost was. And then we divide it by 1 plus the 5% inflation rate. So that's 1.05. So we get $1,542.86, or really you can just round that to 1,543. So again, what does that mean? In beginning of year dollars, the contract's real cost is about $1,543. This means that although you are paying $1,620 now, it only represents a real increase of $43 compared to the original $1,500 after accounting for inflation. So because of inflation, that $1,620 really is more worth $1,543, again, due to inflation. So if you ever have to figure out the real cost of something, this is the way that you would do it. Now with that, let's go to the next question. All right, here we are at question 2. What was the real percentage change in the cost of the subscription adjusted for inflation? Let's go to the top. At the beginning of the year, the cost of a basic software subscription was $200. By the end of the year, the price increased to $220. During the same year, the inflation rate was 5%. So again, what was the real percentage change in the cost of the subscription? So this is somewhat similar to the first question, but now we're figuring out what the percentage change was instead of the real cost. So think about this. Think about what we just did in the first question and give this a try if you want, but if you're not ready, that's okay. We're just going to go ahead and go to the explanation and start learning about this right now. All right, here we are at the answer, A, 5%. So let's go through this. So first, we have to figure out what the nominal rate is, and we can do that by taking the price that it was at the end of the year less the price that it was at the beginning of the year, and that gives us $20, and we divide that by the original starting amount, and that will give us the amount that it increased. So it increased by 10% throughout the year. Now compare that to the inflation rate, which was 5%, so the real rate is the nominal rate less the inflation rate. Now, I will say, this is a less precise way of doing this. There is another way you can calculate this that's more exact, but from what I saw in the AI CPA questions, this one seems to be tested more. So this is the easy and simple way to calculate the real rate, which is again taking the nominal rate less the inflation rate. So 10% less 5%, and that's 5% in this case. That's the real rate. So the real increase in price after adjusting for inflation is 5%. So it's not a 10% increase in price, but it's a 5% increase in price because there was a 5% increase in inflation in reality. Okay, now with that, let's go to the next question. All right, here we are at question 3. What is the real value of the repayment in beginning of year dollars? Okay, let's go up to the top. A borrower took out a $10,000 one-year loan at a fixed interest rate of 4%. At the end of the year, the borrower repaid $10,400, and that was the principal and the interest. That makes sense. $10,000 multiplied by 4% is 400, so that's 10,400. During the year, the inflation rate was 3%. So what is the real value of the repayment in beginning of year dollars? So again, this is similar to the first question where we're trying to calculate what the real value is, what the real cost is. In this case, it's real value. First question was real cost, but very similar idea here. So think about this, pause the video, try to figure this out on your own. And when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. A, $10,097. That is the real value of the repayment, not $10,400. So let's go through this to understand that. To find the real value of the repayment adjusted for inflation, divide the nominal repayment by 1 plus the inflation rate. So the real repayment is you take the nominal repayment, which was $10,400, that's the full amount that was repaid, divide that by 1.03 or 1 plus the inflation rate of 3%. And that actually gives you, looks like I missed an equals sign right here, but you get the idea. That gives you $10,097. So that is the real repayment. So while the lender received $10,400 nominally, that's how much they actually received. Inflation reduced the real value of the repayment to about $10,097. So because of inflation, that $10,400 is really more only $10,097. In other words, the purchasing power gain for the lender was only $97, not $400. That's the kind of effect that inflation can have on debt and on loans and on the amount of money that you get back from things. So it can make a big difference. They lost about $300 of spending power because of inflation. So with that, we learned a little bit more. Now let's go to the next question. All right, here we are at question 4. What is the real cost of the repayment stated in today's dollars? Okay, let's go to the top. A company will repay a $50,000 loan with a lump sum payment of $60,500 in 3 years. The inflation rate is expected to remain steady at 3% annually. So what is the real cost of the repayment stated in today's dollars? So this is somewhat similar to the previous question, but we're trying to figure out what the real cost of the repayment is going to be in 3 years. So take what we learned in question 3, maybe try this on your own. If you have no idea how to do that, that's okay, but give this a try, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer, B, $55,366. That is the real cost of the repayment in today's dollars. So let's go through this. To find the real cost of the repayment, discount the future repayment amount back to today's dollars using the following formula. So the real cost is the future value, so the $60,500, divided by 1 plus the inflation rate, all multiplied or to the power of n, and in this case, n is the years that it's going to be there. So again, $60,500 is the future value, the inflation rate is 3% or 0.03, and the n is the amount of years or the amount of time, so 3 years. So how do we calculate it? Again, we'd go right here, $60,500 divided by 1.03, all to the power of 3. So $60,500 divided by 1.092727 equals about $55,366. There's maybe some slight rounding going on there, but again, the real cost of repaying the loan is about $55,366, not $60,500. This shows how inflation reduces the purchasing power of the repayment over time. So by the time that they actually get to the repayment, this $60,500 that they're repaying is actually more closely worth $55,366 because of inflation. Now with that, let's go to the next question. All right, here we are at question 5. What is the expected future cost of the equipment in 3 years? Let's go up to the top. A manufacturing company is budgeting for equipment it plans to purchase 3 years from now. The equipment currently costs $80,000 and inflation is expected to remain at 4% annually. So again, what is the expected future cost of the equipment in 3 years? So again, we're trying to project how much something is going to cost. This time it's how much it's going to cost based on inflation. So think about this. If you have any idea, that's fine. If not, then let's go ahead and go to the explanation together right now. All right, here we are at the answer. A, $89,989. That is the expected future cost of the equipment in 3 years. So let's figure that out right now. And again, this is including inflation or taking into account inflation. So the future price equals the present price multiplied by 1 plus the inflation rate up to the power of n, which in this case is the years. And again, that's 3 years, just like in question 4. So 80,000 multiplied by 1.04 to the third power, or 80,000 times 1.124864, and that gives us roughly 89,989, with just maybe slight rounding there. So again, the company should expect to pay about $89,989 for the equipment in 3 years, assuming 4% annual inflation. So if they were to buy the equipment today, it's $80,000. And then in future years, if they paid $80,000, they would pay $80,000, but in today's dollars, they'd be paying the equivalent of $89,989 because of inflation. So again, we learned a different way to use inflation to figure out the cost of something, and we learned a lot about inflation throughout these 5 different questions. And before we do anything else, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you how to calculate the future cost of something using inflation, or whatever the case is. Again, you notice these things throughout the questions, and you take a moment and write them out in your own words as the pillar topics, the most important things you learned from the questions. And as you are doing this each day, you are building your own personal repository in your own words of the most important things you need to know for the exam so that you are prepared. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Again, think of this as being something in your own words. The first one, inflation eats away at purchasing power. So a price increase doesn't always mean something costs more in real terms. You have to adjust for inflation to know the true change. Now let's talk about the next one. To figure out what a future payment is worth in today's dollars, divide it by 1 plus the inflation rate raised to the number of years. To estimate what something will cost in the future, take the current price and multiply it by 1 plus the inflation rate for each year you are projecting. So very similar idea there. If inflation ends up being higher than the interest on a loan, the borrower comes out ahead because the repayment is worth less in real dollars. And you could have kind of picked that out from the question that we did on that had to do with interest. And then looking at the real cost of debt or spending helps you see past the dollar amount and understand what's actually being given up or gained once inflation is factored in. So again, kind of summarizing those things in your own words, you might have made different pillar topics than I made, but that's the kind of idea there is you want to pull out the most important things, the key things that you learned in your own words from the questions. And with that, we went over the first 5 questions for this video. Remember, for the YouTube version of this video, we are only doing the first 5 questions. But if you like this and you like our other videos, make sure to check out becoming a Superfast CPA Pro member because you will get access to the full 10-question version of this video when we post it in the member forum. So make sure you check out becoming a pro member. And the easiest way to do that is by going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, that will give you a better path to learning about and becoming a Superfast CPA Pro member. So check out the webinar and then check out becoming a pro member. Now, I hope that you liked this video. If you did like it, make sure to like it and leave a comment in the YouTube video. And with all that said, I hope this was helpful and I will see you in the next video.